Welcome back, traders and investors. I'm not sure our next guest really needs any introduction. Dennis Gartman of the Gartman Letter. We are lucky to have him as a guest today. Dennis, how you doing?
Well, I'm old and tired, but I'm doing okay.
Yeah, that's okay. Getting ready for the 4th of July. Well, you got a pretty good background in the commodities and futures markets. Just why don't you kind of just give us a little bit of your education and how you ended up where you are?
Well, I finished graduate school at my beloved North Carolina State, not to be confused with the hated University of North Carolina. Back in the early 1970s, got my first job out of grad school was as an economist at Cotton Incorporated. Spent a couple of years trading foreign exchange for what was then NCNB, North Carolina National Bank, in the middle 1970s. Conned my way onto the Board of Trade in Chicago late in the 70s until the early 80s. Traded in the bond pit for a number of years. Traded the bonds versus notes and Ginnie Mae's versus notes. And for the last, since 1984, have been writing the Gartman Letter every day. And proud to say that I have never missed a single day except for one day when I took the day off to celebrate my parents' 50th wedding anniversary. So I've been doing this for a very long period of time. Put my own money at risk every day, and I think there's something to be said for that.
Dennis, I've been a big fan of yours for a long time, and something I always think about is you're a big fan of obviously staying with the trend, and you always say on CNBC, look at the stock charts going from the bottom left to the top of the right, and those are the ones you want to be in. And this trend in this market has been just going up for the last 5 years here. Do you continue to think this trend continues here going forward, or what are your thoughts here on this bull market? Because it seems like it's unstoppable.
You can write this down. It'll stop when it stops, and it won't stop an instant before then. I think it was Paul Jones who had the greatest line ever when asked, "Who's the best trader you've ever seen?" And he said, "It was my 4-year-old nephew, Bobby, because I can hold a chart in front of Bobby and say, which direction is this going? And he'll say, that's going up, Uncle Paul." Or another chart can be held in front of him and say, that's going down, Uncle Paul. Sometimes you have to be that simplistic. This one continues to go up. It continues to move from the lower left to the upper right. The monetary authorities continue to expand the supply of reserves. The demand for plant and equipment and labor is simply not strong enough yet. It will be eventually to overcome that supply of reserves, and those reserves are finding their way into the capital markets. It's still a bull market. And what amuses me, or what dismays me, is how many very smart people have continued to be bearish all the way up for very good reasons. Clearly, it would be far better if the economy were self-sustaining. Clearly, we'd prefer not having to have the monetary authorities be as aggressive as they have been. But they have been, they are, and to fade the market because of the monetary authorities being aggressively expansive is a mug's game, a loser's game, a very bad game. But it's been played by some of the smartest people I know, and I find that very dismaying and discouraging for those folks. It's a bull market. It will continue until it stops. It will continue until trend lines are broken. It will continue until we stop making new highs when we break and take out a previous low. Keep it simple. Try your best to understand that the economy is doing reasonably well, not phenomenally well, not extraordinarily well, but nor is it doing poorly. It's doing reasonably well. And in that environment, with the monetary authorities being aggressive, stock prices have to continue to move from the lower left to the upper right.
What does that mean for gold? Because I know you follow gold very closely, and gold is obviously usually a safe haven for stocks, or for when stocks are going down, gold's going up, or when stocks are going up, gold is usually going down. Is this still bad news for the gold bugs?
No, I don't think it's bad news for the gold bugs at all. I think gold is misunderstood. I think in the modern world, gold is nothing more than another currency. It is neither better nor worse than is the euro. It is neither better nor worse than the dollar, better nor worse than the British pound sterling. It is not better nor worse than the Chinese renminbi. It is simply one of many currencies whose value goes up and down relative to those other currencies. And I think if you can divorce yourself from the notion that it is a safe haven, because I don't think it is anymore, if you can divorce yourself from the fact that it's supposedly or used to go up or down predicated upon inflationary pressures or deflationary pressures, if you can simply allow yourself to understand that it is a currency that sometimes money moves into and sometimes money moves out of, if you can divorce yourself from the gold bugginess that too many of the gold bugs have, I think you'll end up trading gold a lot better. So I'm quite bullish of gold in euro terms. I'm very bullish of gold in terms of the yen crossing one against the other. I'm relatively neutral of gold relative to the U.S. dollar, although I have to admit that finally, for the first time since November of 2011, we've stopped going down. We've started at least to go sideways for gold in dollar terms, and perhaps we may begin to see gold in dollar terms moving quietly upward. But it's been a much better trade to have been long of gold in non-U.S. dollar terms, a far, far better trade. I just went to North Carolina State, so I'm not as good at the math as fellows from Harvard or Yale or Virginia or Carolina, but I think if you're down 1% over the course of the last 2 years by owning gold in yen terms, that's better than being down 30%. But I'm ready to stand corrected on that.
Okay, Dennis, I've been going over your Gartman letter over the last couple days, and boy, you got an interesting mix of fundamentals and technicals. Could you just describe, I mean, is it a 50-50 split, or do you use the fundamentals to form your opinion and then look for something on the charts, or do you let your charts, look at the charts and say, man, I got to figure out what's going on in the fundamentals?
Yes, and yes. I think that on balance, I'm 50-50. I think that on balance, actually, I think on balance, I'm 55-45. That is, I really want to understand why something is moving fundamentally. I want to understand whether the conditions are bullish or bearish. Is there a lack of supply? Is there an increase in demand? Is somebody else in a stronger position of authority? Has something changed in one of the commodities? I want to understand why something should be going up, and then I want to go take a look at the charts and say, is it in fact going up? A good case in point right now is the grain market. I mean, over the course of the last 6 weeks, the rain on the corn crop, the rain on the soybean crop has been just phenomenal. I mean, it's just wonderful growing conditions. And that made it abundantly clear that the size of the crop was going to be growing. Well, take a look at what has happened. Prices began breaking trend lines. The term structures began to weaken, I should say. You started to put carrying charge into the new crop corn contracts. All of the things were moving technically and fundamentally to be bearish of the grain market, and one has to be. So I think on balance, I think that I'm probably 55% a fundamentalist and 45% a technician. But there are times when that might switch the other way. I guess if I'm anything, I'm a pragmatist. I will steal from both schools of thought.
Okay, that's excellent. And the technicals, and I know a lot of your stuff is longer term. So will you look at anything shorter than shorter term than a daily chart? Maybe something intraday, or do you even like not to mess with the dailies and go with the weeklies and the monthlies?
Oh, I'd steal from all of them. There are times when I'm looking to add to a currency trade. For example, I've been long of the English-speaking currencies, as I like to call them, short of the Japanese yen, and they just broke out finally through the daily charts. They've just broken out finally through the weekly charts. They're beginning to break out finally through the monthly charts. I'm going to pay attention to those, but if I'm trying to get more on from my own account, I'm going to put the 5 and 10 minute and 30-minute charts up there to try to get better execution. So it's a wonderful world in which we live with computers in front of us that give us the capabilities of looking at very short-term and very long-term phenomena. So again, being a pragmatist, I'll steal from everything.
What types of technical indicators do you use? Are you just looking like the overall trends? Are you using moving averages? Are you looking for breakouts? Like, what are you really looking at in the technicals, Dennis?
I keep it simple, and the older I get, and the simpler I get. I don't know anything about Fibonacci. I don't know anything about 5 waves. I know very little about moving average crossovers. I basically want to look at is something making higher highs and higher lows? Is it moving from the lower left to the upper right? I pay a lot of attention, and this will sound, a lot of people won't understand this, but especially when it comes to the commodity markets, I pay a great deal of attention to what the term structures are doing. What's the front month doing relative to the second, to the third, to the fourth, to the fifth contract back? In good bull markets, the front contract should always be the stronger, even on down days. I'll pay attention to that sort of thing. That's especially true in carrying charge markets, and it's especially true in crude oil. So I really do try to keep it as simple as possible. I find esoterica, I find complexity breeds confusion, and confusion breeds contempt. So the simpler I keep it, the better off I am. I draw very simple charts, very simple trend lines, and I try to keep the pencil with which I draw the trend lines fairly dull, so that the trend line can be broken fairly substantively before I pay it a great good deal of heed. But simple beats complex every single time.
Okay, I'm also looking at your newsletter. I noticed that you trade a lot of spreads, and and are you doing that just to kind of to minimize your risk, or is it just the way that you've always traded? I remember I traded at Bright Trading for a long time, and Bob Bright used to mention spreads, and he said sometimes he didn't like spreads because you can lock in a loss on both ends. But tell us why you like to use that technique.
Well, I was raised to look at relative value of things. And quite honestly, spreads can be far more dangerous than an outright position. No ifs, ands, or buts about it. And anybody who tells you that spreads reduce volatility is lying or naive or both. Spreads can be very difficult. But I've always tended to look at relative values of one thing relative to another. I'll trade corn against wheat. I'll trade Kansas City wheat against Chicago wheat. I'll trade sterling against the yen. I'll trade yen against Canada. I'll trade gold against the currencies. I've just always tended to be a finder of relative value, and it just works for me. That doesn't, and I look at the spread relationship or the spread price as if it were one price. If I'm looking at the price of Kansas City wheat versus Chicago wheat, you keep a chart of that, and it's a number dancing across the page. It moves from $1.25 to $1.19 to $1.11 back to $1.18. It is a price no different than a stock price moving across a page. So I just happen to have been raised or trained myself to think in relative terms. That doesn't mean it's good, bad, or indifferent. It just means that that's what I do, and I feel comfortable with it.
Okay. Do you play both sides of the market? You seem a veteran of the markets. Are you as excited to find a juicy short as you are to go long? I mean, obviously, obviously in this market,
absolutely.
The shorts have not been coming to fruition. But so you'll play both sides in the market.
Oh, absolutely. And anybody who doesn't, I think, is doing themselves a disservice. Which brings me to a point that I'd like to comment upon, if I can. Commodity funds, the long-only funds, are about the stupidest idea I think I've ever heard of in my life. Commodities are not an asset class, and anybody who believes that should disabuse themselves of that notion. The relationship between cocoa and bonds, I'm not sure there is one. The relationship between cotton and crude oil, I'm not sure there is one. The relationship between corn and hogs, well, there might be one, but it's tacit at best. But yet everybody tried to buy the notion of being that commodities were an asset that move up and down in tandem with the other. Just the silliest notion I've ever heard of. Commodities move higher, some move lower, and you have to be prepared in the commodity market to be as willing to be bearish as you are to be bullish. And if you can't do that, quit now.
Okay, let's move on here. Michael Lewis made his big comment a couple months ago about high-frequency trading in the markets, that the markets are rigged. In your opinion, are the markets rigged?
No, the markets are not rigged. What a silly comment that was. He's an idiot. No. And I think that the high-frequency traders should be given credit for doing something that the government forced them to do. The government basically killed, in the stock market, killed the specialists who had a wonderful business for many, many years. When stocks had eighths and quarters bid and offered, the specialists were making a fortune on those eighths and quarters. Now that we've moved to pennies, first of all, any good stock on the New York Stock Exchange trades basically at a 1 to 2 penny bid to offer instead of eighths to quarters bid to offer. And two, the high frequency people are the only people who create liquidity or who are makers of liquidity more often than not. Oh, they step aside at times when things get terribly volatile, but so too do you. I don't know of anybody who steps into the middle of the type of volatility that we had on Flash Crash Day. Everybody stepped aside for a while. It would have killed all the specialists, and the few remaining specialists that there were did get hurt egregiously badly. But I think the high-frequency people should be applauded because it was they who brought the spreads down to pennies instead of eighths and quarters, and it is they who are the only ones who offer liquidity when sometimes liquidity seems to vanish. So I don't think the market's rigged. Oh, they can play games, run ahead of them, other orders, get back, take orders out very quickly, but they're doing it for a penny, for a tenth of a penny, for a hundredth of a penny, instead of eighths and quarters as in the old days. No, I just find the term rigged, the term that the public is being ill-treated, is just wrong. The public is getting a better deal now than the public has ever gotten. You're paying less in brokerage and paying smaller bids and offers. It is so much a fairer game than it ever has been, and I say God bless the high-frequency traders. I know I'll make many people angry with that. I really don't care.
Yeah, that's good. It's good to have your opinion. One quick question here in the chat room. The semiconductor has been on fire. I think we were noting like 6 or 7 quarters of consecutive gains. Is this something that you have a take on, the semiconductor index?
No, I really don't. That's beyond my ken. I'm just a poor boy from North Carolina State. I'm not smart enough to deal with those sorts of things.
Do you use options at all? I know you do the spread
sure.
trading. So how do you like to use the options? Are you more of a premium seller, take it into premium, or if you think you have a great idea in something and you don't want to trade the equity, you use the options markets?
Yes and yes. The biggest position we have on in my retirement account right now is long aluminum. And we've been writing covered calls against our aluminum stock all the way up. It's wonderful. It's paying a dividend. We tend to write just a little bit out of the money, and when we get close to the money or get a little bit into it, we roll them up. It's been just a wonderful way of increasing yield, and it makes me feel a little more comfortable. So I've tended to be doing that now for the past 8 months, writing covered calls against a continuously larger and larger and ever larger position in aluminum. We've had a position in Apple Computer. I've done the same thing, selling out of the money calls. I can't believe how much people are willing to pay for reasonably decently out of the money calls on Apple. Now I'm looking at the fact that, you know what, I like Apple enough that I don't want to own the shares, but I'd like to own the shares, so I'm actually considering owning deep in the money calls just so that I have less money at risk, but basically have the same position on. I don't, however, use options as to take speculative positions. I've just tended not to do that, and I have to tell you, I'm not terribly bright, and I don't use terribly sophisticated computer technologies to tell me whether an option is expensive or not. There are other people who do that. I wish them very well. They're probably going to beat me in the options area that I deal in. I'm comfortable with letting them earn their money, scalping options to make 2 pennies away from me. God bless them. I wish them well.
Okay. Fundamental question here coming from the chat room. And how does the U.S. pay back the never-ending debt accumulating every year?
By economic growth, by population growth, by larger tax revenues as the economy strengthens. It will happen. It'll happen when we finally don't have a socialist president anymore, but we have to wait several years for that to occur. But growth trumps everything else. And I'm still a believer in the United States. I still believe that we are the great shining light. We have been the great shining light. And give us a chance in the future again to grow the economy at 4.5%, and we will get there again. When you get a 4.5% growth in the economy in a what will eventually be a $20 trillion economy. It will eventually be a $25 trillion economy. It will eventually be a $30 trillion economy. the tax revenues that flow in will be astonishing. So we will pay that debt down through growth. We won't pay it down any other way, and the one way that we won't pay it down is by raising marginal taxes. That's the quickest way to doom yourself. So I'm still a believer in growth, and that's how we will do it. I'm still a great believer in the efficacy and the validity of the United States as the shining light of capitalism, and I think that we haven't given up that crown yet, and I don't think we ever shall.
What a great guest to have on 2 days before the 4th of July here, singing the praises of our country. Great timing from Brianna. So to close things out here, you've given us your opinion on the market here. Just reiterate it for our people that joined us late here. The bull is definitely breakaway bull here. Just give us your short-term outlook here, maybe for the next few months, and then a little bit of a longer-term outlook.
Yesterday we had a melt-up. And we're probably going to consolidate those gains. I doubt that we're going to go racing higher again, but the trend is still from the lower left to the upper right. It will continue to be that way until it stops. There's nothing more that I can say. Quite honestly, until the last of the rather public bears gives up, the market will continue to blow up in their face. Until the monetary authorities suspend the growth of the monetary aggregates, the market will continue to go from the lower left to the upper right. Until such time as economic growth is so strong that it demands capital, that plant and equipment and labor begin to become inflationarily demanded, stock prices will continue to go up. History shows that stock prices continue to advance until the economy really gets on its best legs. That's why stocks go up before economic activity turns up. That's why stocks go down before economic activity turns down. To be quite honest, I don't think the stock market will turn materially downward until we return to 3.5 or 4% GDP growth for several quarters. And then when businessmen and businesswomen get excited about their own growth prospects and begin to move money out of the capital markets and begin to move money into plant and equipment, only then will stock prices come under long-term protracted selling. So, I've been bullish. I want to continue to be bullish. I think that the prospects of the economy are quite strong, and it's just amusing to me, but at the same time dismaying to me, how many truly bright people have for the last 4 years consistently said this can't continue. It will continue until it stops.
Okay, Dennis Gartman, author of the Gartman Letter, veteran of the markets going back to the early 70s and 80s. Dennis, thanks a lot for coming on. Great interview, great advice for our traders and investors out there. Have a good trading day, good 4th of July, and we'd certainly like to have you on again.
I was honored to be asked. Look forward to it, and God bless America.